Is the Bay Area housing bubble gonna pop soon? My prediction, no, because we're actually not in a bubble. And that's what we're gonna cover in today's video, and we're gonna start right now. Hey guys, Hans Struzina with the Gunderman Group at Keller Williams Luxury International. And before you make a judgment on this video, because it's a real estate agent talking about how we're not in a bubble, give me just a chance here to tell you what I'm seeing. I did a bunch of research this week on this exact topic because I was going to make a video about how the market is a bit overinflated and we're probably going to crash because that's what everyone else is doing on YouTube. However, I found some interesting data that makes me think a little different. Maybe that it's not necessarily a bubble, but maybe the market will correct it, but it's just not going to be the same as last time. And if you get some value out of this video, give it a thumbs up and subscribe to the channel because I am going to continue to put out weekly content just like this and you're not going to want to miss it. So without any further ado, let's get into it. First and foremost, we need to define what a bubble actually is. So according to Investopedia, a housing bubble or real estate bubble is a run-up on housing prices fueled by demand, speculation, and exuberant spending to the point of collapse. Housing bubbles usually start with an increase in demand in the face of limited supply, so that's exactly where we are and have been for a long time here in California, in the Bay Area specifically. Additionally, speculators generally pour money into the market, further driving demand, and at some point demand decreases or stagnates and prices drop. That's when the bubble pops. Housing bubbles are always temporary, but can last for years, and they are usually started and driven by unusual behavior in the marketplace, like what I just described. The limited or excess demand, limited supply, speculation, high investment, high liquidity, that sort of thing, that really inflates artificially the prices, and then eventually that demand stagnates and it crashes, heads popping. So a lot of people would suggest, because of coronavirus and all this economic uncertainty that we're facing, especially with the election and taxes and pre-election stuff, it was hard to say what direction we were going in, and it was just a matter of time before we turned into another 2008. Though I did, like I said, a bunch of research through California Association of Realtors, who looks at market data historically and through today, and I pulled some interesting slides that I wanted to share with you, which are leading me to believe that we're not in a bubble right now, and here's where we started. Number one is the jobs. Supply and demand is at the core of any real estate market in any bubble. We have definitely seen a disproportionate amount of demand relative to supply in the Bay Area. That's why prices have gone up. Since a lot of jobs were lost since the coronavirus pandemic broke out, most people would think this is sort of artificial. However, when you look at the distribution of who lost their jobs, it's primarily here in the state of California, the wage earners, the hourly people, the lower income side of the equation. And while that is absolutely terrible and something that needs to be addressed, that is, generally speaking, our renting population. Is not our homeowning population, because of how expensive the single family homes and just housing in general is right now. That's another topic for another story, or for another video. That being said, the white collar individuals, professionals, office workers, tech workers, all of those people did relatively okay, and in fact in some cases increased since the pandemic broke out. And that, by and large, is the class of people who are transacting on real estate, is the people who have those higher paying jobs. They're doing well overall. And that has, of course, pushed housing prices up the ladder. And I'll show you in just a second, the number of units in the state of California that transact every year has been very steady over the last several decades, which is really interesting when you look at it and you want to break that down. But that same unit has trended upwards, hence the value's gone up, and here we are today. The median California price for a home right now is $706,000. Shocking, I know, right? It's crazy. And this is the topic of so many videos, and this is the point. This is why everyone thinks we're in a bubble, because prices are so high, right? Well, let's break this down in a couple different ways. Number one, if you could put 20% down, now admittedly, that's quite a lot of money for someone to save up. to put down, especially when rent and all the other taxes and other cost of living are really high here. But assuming you could, you'd have a $564,800 mortgage at 3.25%. That puts you at a payment and interest of $2,458 a month. Now, disclaimer, I'm not a lender, I can't quote rates, I don't know your situation. Make sure you talk to somebody before you go use that rate to go shopping for a home. So the reason I bring that up is because $2,400 for a home, especially depending on where you are, is not particularly outrageous. That's a little less than what I'm paying for my current place. And I know for a fact that my 2-bedroom, 1-bathroom here in Alameda is absolutely not at market rate. So there are a lot of people who are able to make that payment here locally in the Bay Area. And so that medium price, assuming you can get to that 20% down, is not unachievable for many. Which actually brings me to an interesting point, is that affordability, which is, as you can see here, the affordability index, the housing payment versus the income, is lower than it was in 2007. So people are not stretching themselves to the same level as they were from an affordability standpoint, which we'll get into some of that foreclosure stuff here in just a second. Additionally, when we're talking about speculation, a handful of years ago, everyone was really concerned about all cash foreign investment. Generally Chinese, Australian, Russian buyers coming in and plunking down all cash, not ever moving in, but as a place to put money, right? Well, that is down across the board substantially, as you can see here. So you're not getting that same speculation, that foreign investment that's further driving up. And in fact, as prices have gone up here locally, that has steadily decreased as a trend. Interestingly though, as you can see, the population has definitely increased over the last several decades, and we're almost at 40 million residents here. But the permits that have been drawn statewide are substantially lower. That means new construction is a lot lower. It'll be interesting to see if there's an impact on that relative to the Biden tax plan and affordable housing and all that stuff, which is another video that I'll do later. But it's going to be really fascinating to watch that trend because new construction just hasn't been a thing, especially here locally. There has not been the supply increase yet to meet the surge of demand. And as you can see, even though there's a lot of people leaving the state, it's actually as high, if not higher than it was in 2005. The population overall has still grown, and so basically there's people coming in from out of state to fill the gap of the 30% of people who sold their homes who are now leaving to other states. Really interesting to watch that, again, supply and demand imbalance. So the mortgage forbearance thing is another big concern because people think, if a lot of properties again get foreclosed on, it's going to be a total madhouse. There's going to be a surge of inventory that comes in of all these REOs and bank-owned properties. And that is going to lead us to another move towards the bubble bursting, because those banks, generally speaking, sell at a discount and sell at a lower price, right? Well, according to what we estimate here in California, at least, only about of the 600,000 nationally, we're going to get about 60,000 of them. And when you disperse that across all the metro areas, it's not a huge impact. And when you look at the predictions of how much or how little versus market value, you are going to see, if the REO took 30% market share and sold for a 40% discount, that wouldn't necessarily drive the whole thing down in a huge flaming ball of fire, necessarily. And there's probably a middle ground here as well. That's not to say it won't necessarily take prices down, but it's not going to totally tank them as far as I can tell as of today. So lastly, the other really interesting thing that's really important to note relative to foreclosures is that people are keeping their equity in their homes. So even compared to 2007, we are like a third of how much equity people are cashing out. And if you've tried to buy a house or refinance anytime in the last 6 months, you know that there's a huge run on refis because rates are so low. and the appraiser's all backed up and all that stuff. But even with all that refinancing and cashing out and HELOCs and all that sort of stuff, you're not seeing people take equity out of their properties at the same rate as before. So because there's that equity cushion sitting in the property, the likelihood of the default happening at the same rate is very low. And probably people are not going to walk away from a huge equity position in a property if they get into trouble. They'll just sell it on the open market. And then the last one that I want to address is the speculation component of our definition from earlier. Speculation is interesting because it's that in a nutshell is one of the big issues from the 2008 crisis, when people were assuming housing prices were going to continue to go up and rates were going to go down and people were just going to keep humming along, right? The use of adjustable rate mortgages is as low as it's ever been, if not lower. Therefore, that speculation component is gone because that's what the adjustable rate does. It says, I can just refinance in the future to another low rate and I'll be good. So you're speculating into the future. People are not behaving that way as they once were. So that speculation component plus the foreign investment being down is not here in the same way. So here's the deal. I don't see a bubble here locally. Nationally, possibly, but locally, no. Demand is really high, absolutely, and it has been for a really long time. So that hasn't changed. I'm actually seeing the speculation activity go down. Use of adjustable rate mortgages and foreign investment, those are way, way down. Not to mention the fact that a lot of the foreclosures that we're seeing are going to have some kind of repayment program or some long-term for people to kind of get back on their feet. That's just going to be part of the deal. And it'll be really interesting to see what happens, but ultimately the market is sound. I think what is really truly happening is people are valuing home differently right now. People are seeing a yard and a work from home space and a place to have their kids be safe and learn from, and all of those kind of factors that people put into a house. I think that that's taken on more value than it used to. And I think that is partially why you're seeing the values increase. Not to mention the fact that the people who are actually able to save up that substantial $150 or more $1,000 down payment and afford the monthly are the ones who are doing well economically right now. And those are the people who are driving, generally speaking, the single family home market here locally. So if you got some value out of this, give the video a thumbs up and subscribe to the channel because I'm going to continue to put out weekly content like this. And if you disagree with me, you agree with me, whatever, down in the comments, let's have a chat. I'd love to hear what your side of it, what you're seeing, what you're feeling and hearing, because this is a really interesting conversation that's going to affect a lot of us going forward. So without any further ado, I'm going to log it off for today. This is Hans Struzina with the Gunderman Group at Keller Williams Luxury International, signing off for now. See you guys on the next one.